Fed meeting this week, and the odds of a rate hike are now at about 90%. And with that, let's quickly welcome to the program a returning guest, Stephen Esposito, Senior VP and Wealth Advisor with Morgan Stanley in Lake Forest. Good morning, Steve. How are you?
Good morning. How are you?
Good. So quickly, what can we expect from the Fed meeting this week?
As you said earlier, a few minutes ago, about a 90% probability they're going to raise rates about a quarter point here coming this week, which it wouldn't be unexpected. I think if they don't, the market that would be unexpected if they didn't.
So with Trump's plans, which are inchoate at the moment, but it seems like there's going to be stimulus and there's going to be deregulation and tax cuts, are we talking about inflationary pressure?
Potentially. I mean, the market, we've been hungry for inflation for a while now. There's been the concern has been deflation for years. If you remember back in 2011 when all the banks, ECB, and all the banks all over the world, United Fed, were printing money to talk to us, we would have rampant inflation, and gold subsequently went to $1,900 an ounce. We're now 5 years later, and we're below $1,200 an ounce. So it's been a deflationary concern all over the world. Now the stimulus may cause some inflation, which I think would be good for the economy. Get wages up, get some commodity prices a little higher, et cetera. So I think it's all positive going forward.
So what kind of an impact would a quarter point rate hike have on the average consumer or investor?
Really nothing. It's not going to mean it's more sending a message and a signal from the Fed that the economy is finally on track to grow, as opposed to what we've been having for years, where the Fed just didn't feel comfortable. The stopping and starting of the economy, the sputtering, so to speak, stopped the Fed from having any confidence to raise rates.
Yes.
Now they're saying we have some confidence. Let's put our toe in the water, see what happens. And the talk is maybe get another two, depending on the data, we could get another 2 or 3 rate hikes in 2017.
And the markets are closing on such highs. I mean, why are we seeing such a spike in the markets post-election?
You've had a monumental attitude adjustment in the financial markets. One from where we can't do better than 2% growth, that's the new norm, that's the new world, to suddenly 3 to 4% growth is possible. You're going to see fiscal stimulus, which is exciting the market.
Well, but the thing is that, I mean, so we had 3.2% growth, but, I mean, didn't we have these blips before, and then we settled back?
Well, yeah, in the past you had bust and boom. We haven't had any real bust because we haven't had a real boom in the last 8 years.
No, but I'm talking about, is the confidence, not justified because of the recent 3.2% growth? Because it normalizes at the new normal of 2%. We have real bad growth quarters as well.
Well, that's if you're assuming the new normal is still going to be 2%. That has been the belief over the last several years. The question is, the markets now believe the new normal of 2% isn't going to be the normal going forward. And up until now, all you've had, and again, you're starting at the fiscal stimulus actually kick in. It hasn't been passed. But all you've had really is the Federal Reserve all by itself creating all of the stimulus, pedal to the metal stimulus you've seen with lowest interest rates and capital and bond buybacks, et cetera, all over the world. Now the hope is that the Fed no longer has to carry all the water, that the fiscal side will now step in and create more of a balanced growth in the economy, allowing the Fed to pull back, raise interest rates, which helps savers, which have seen no returns in money markets and CDs, of course. And now the fiscal side will start to pick up and do their share towards the economy. That's what the market's hoping for. And it appears if we get these tax cuts, regulatory relief, et cetera, and even the energy sector starting to come back, which is a part of the economy that's been dragging earnings in the economy, you could have us hopefully hitting on all cylinders going forward, and that's what the market is expecting.
All right, thanks so much.
It's got to happen.
All right, thanks so much. We have to leave it there for today. Steve Esposito, Senior VP and Wealth Advisor with Morgan Stanley in Lake Forest.
And now, a moment of